Old energy names in your portfolio. You know that we had a pretty good run in that space for the first half of this year, but oil has fallen on some hard days in recent sessions. We had a losing streak for West Texas Intermediate. You have concerns about demand in the face of the Delta variant. It's a lot to digest, but of course the key is always, where do we head from here? Josh Young, Chief Investment Officer of Bison Interests, and he joins us now. Josh, great to have you back. All right, so it's not pretty right now. You take a look at the past 5-6 days in crude, and it's a downward trajectory. Do you think that we got more pain ahead, or are we going to bottom out soon?
It's always hard to predict the short term. It definitely seems like oil is being whacked by a combination of increased COVID cases as well as concern about the economy in China. And I think both of those are relatively short-term concerns. China's been on a long-term growth trajectory, and it looks like we're getting close to a peak of this COVID wave. So I'm optimistic. I don't know exactly when this bottoms, but I've been buying as recently as just now.
Okay, so you're seeing it as a buying opportunity. How should we be playing it as investors? Should we be playing it through some of the, I guess, the biggest producers, or is there a little more torque out there?
Yeah, so I still don't think it's a great idea to own the Suncors of the world. I'm a little less negative on them as their operational issues are better understood, and after Goldman pulled them off their conviction buy list. I really like Baytex here still. Baytex announced some more well results at a conference, or they gave more color on those well results at a conference I was just at earlier this week in Denver. I don't think people understand just how good or how big their discovery is in the Clearwater play. And there's some other names as well that I think are really interesting here.
Okay, so apart from oil, you have an idea for us, and I think it's more, it's hooked with ethane. Okay, tell me what ethane is, because I don't know the space as well as you, and then tell me about the name that has exposure to it.
Sure. Yeah, it's ethane is one of the natural gas liquids. So as you go from natural gas, which is purely gas at room temperature, to oil, which is purely liquid at room temperature, there's a whole range of liquids that can come out of the gas as you cool it. So people are more familiar with butane, which is used in lighters, or propane, which is used for their grills. The outdoor grills. And so ethane is the lightest natural gas liquid, and it's something that used to be in short supply and very valuable. And then during this shale gas boom, it got glutted. It's produced fairly commonly with natural gas. And so what's happened is that because prices were so low here in the US and in Canada, there's been a lot of exports of ethane, and that's increased a lot over the last 10 years to China and other places like that. And then there's been a lot of petrochemical facility construction to the tune of tens of billions of dollars of plants that are in construction and finishing right now. And so what's happening is, as that ethane is going from a glut to potentially a shortage, or at least a fairly balanced market, the price of ethane is rising. It's up almost 100% year over year, and it's in the process of decoupling from natural gas. It used to just be priced based on natural gas, and it's something that's more valuable than gas. And it's very similar to propane, where propane prices were very low last year, and they're up almost 4x in the last year, and propane producers have done extremely well, both in the US and in Canada.
All right, a great primer for our audience. Perhaps some people who weren't familiar with the product itself. So Sandridge Energy, is this the way to play it?
Yeah, so I really like Sandridge here. I've put out stuff about it. I've liked it since a lot lower prices, but it's one of those things where there are a number of different investors and sell-side firms that talk a lot about free cash flow and free cash flow yields, and Sandridge trades at an unimaginably low multiple to its cash flow, close to a 1x free cash flow multiple, which is almost 100% free cash flow yield. It's a company that was very famous and went bankrupt after being worth $10 billion. It's reemerged and is trading on the public markets here in the US. And about a third or so of its production is natural gas liquids, most of which is ethane. And so People don't like Sandridge because they used to own it before it went bankrupt and lost money on it in many cases, or they don't like it because they look at the company and the trailing margins were terrible because it was a gas and NGL producer at a time where gas and NGLs were very low margin. But as these petrochemical facilities come on and as the gas market settles out at this kind of new higher $3.50 to $4 or so per MCF range, ethane and natural gas for Sandridge will generate much better margins. And the stock is just way too cheap on any measure compared to anything in the US and Canada. And it has like $1 a share in cash, and it's building that cash balance in net cash, and it's building that cash balance by about $1 a share per quarter. And the stock is around $8.
Very intriguing idea for our audience. You always bring bring the good ones, Josh. The entire conversation with the fact that we're talking about ethane, when we started about talking about oil and gas, it just sort of reminds me of the fact that as much as we're seeing shifts in how people want to, produce and source energy, there's a lot of byproducts from traditional oil and gas that one would assume are still going to be in demand for quite some time.
Yeah, I think it really challenges the thesis that oil is going away or that demand is going away anytime soon. Got to see an industry consultant give a presentation about what they think will happen to demand for oil, and that wasn't even addressing natural gas liquids. And it looks like even in a situation where there's a successful transition to hit the Paris targets and all of that with a 1.5 degree kind of cap, even in that situation, which we're not on track for at all, you'd still see almost as much demand for oil 20 years from now as you see right now. And when you factor in stuff like ethane, where demand is increasing, not decreasing, things look pretty good for the industry for some time versus valuations which are ridiculously low, and companies like Sandridge and Baytex that are very undervalued and very compelling here, even in an uncertain market.